All right, so US markets are closed for Good Friday, but you know what? Global macro forces, they never take a day off. So what are the markets telling us while they're supposed to be quiet? Let's take a high-speed look at the live data right now.
First up, oil is pushing above WTI price.
Meanwhile, Bitcoin is buzzing, holding strong at SwarTTC price, and the dollar index, the DXY, is sitting firm at $DXY. You see what's happening here? The message from these live signals is crystal clear. Even with US markets shut down, crypto is leading the charge on price discovery today. So, what does this all actually mean? Well, it puts us squarely in a regime of inflationary pressure. With oil over WTI price and a strong dollar, liquidity gets tight. And since the main stock markets are offline, we're forced to look at crypto and foreign exchange as the real-time engines telling us exactly where things are headed.
Let's start with what is really the center of gravity for this entire story: energy.
Just look at this. You've got both WTI and Brent crude holding strong above that absolutely critical $100 mark. And listen, this isn't just some number. It's a powerful statement about persistent inflationary pressure.
And here's the crucial point. When oil stays this high, especially during a low-volume holiday, it keeps inflation expectations jacked up for everyone. I mean, think about it. Energy costs feed directly into literally everything, from transportation to manufacturing. So while the energy markets might seem quiet, this price level is screaming that inflation risk is very, very much alive and just waiting for Monday's open. This brings us to a really fascinating concept. What happens to all that market anxiety, all that volatility, when the main exchanges are closed? It's not like it just vanishes into thin air. It migrates. You see, the VIX, Wall Street's so-called fear gauge, it's frozen. So all that energy has to go somewhere, and it moves into the markets that are still open, primarily crypto and foreign exchange. They essentially become our proxies, absorbing and reflecting global risk sentiment in real time. And this is exactly why it matters. The S&P 500, it last closed at S&P 500, looking pretty resilient. But all this new data coming in over the holiday, like these high oil prices, creates what we call repricing risk. The market that reopens on Monday is going to have to instantly account for everything that's happened since Thursday. And believe me, it might look very different.
Now let's add another layer to this. Take a look at gold. It's also way up there. But as this slide points out, seeing gold rise while equities are also strong, well, that's not really a sign of panic. It's hedging. It means investors are buying insurance while keeping their riskier bets on the table. That is a classic late cycle pattern.
And this brings us to the most active market today, crypto. During this holiday, it's pretty much carrying the entire macro load on its back, giving us this incredible real-time feed on global sentiment. So, right now, Bitcoin is holding a key line in the sand above the $30,000 level. This is a critical support zone. As long as it stays above this, it kind of suggests there's enough supportive liquidity in the system and that global risk appetite is holding steady. However, the trigger we're all watching for is a break below $30,000. If that happens, it would be a clear-as-day signal that risk appetite is weakening across the board, and it would give us a major clue about how Monday's open is going to feel. For today, crypto is our sentiment feed. Okay, now let's connect all these dots. How does one signal actually transmit through the entire financial system? Well, it's all part of a chain reaction.
And this illustrates that chain perfectly. First, you have oil staying above $100. That directly pumps up expectations of rising inflation. In response, what happens? Bond yields follow suit, with the 10-year Treasury pushing up near 4.3%. This in turn strengthens the US dollar as investors chase those higher returns. See, it's a clear four-step transmission of pressure right through the system.
And this whole narrative just got a major shot in the arm from some fresh labor market data. Unemployment actually fell to 4.3%, beating forecasts. And private payrolls, they came in at a whopping 178,000, absolutely crushing the expected 60,000. A strong labor market like this basically kills the chances of near-term rate cuts and reinforces that entire inflation story we just walked through. So, with all this information we've gathered from a supposedly quiet holiday, what can we expect when that opening bell rings on Monday? Let's break down the potential scenarios. We've got four main paths. Scenario A is just a stable holiday, where things stay more or less where they are. Scenario B is where that inflation narrative gets stronger, with oil climbing and really putting pressure on stocks. Scenario C is a risk-off move, where you see Bitcoin break down and investors just flee to safety. And finally, Scenario D,
That's a tail risk event with a major spike in the dollar and yields, causing a broad market sell-off.
So let's get specific. Here are the signposts for Monday that will tell us which path we're actually on. You're going to want to watch for oil pushing past $110, the DXY breaking above 100, the 10-year yield crossing 4.4%, and that key Bitcoin level of $65,000. These are the triggers that really matter.
So the crucial point here, the main takeaway from all of this, is that even these quiet holiday sessions can reveal the powerful undercurrents flowing through the market. And today, the dominant signal is one of persistent inflation pressure, and it's being broadcast loud and clear through the energy, crypto, and FX markets. And that leaves us with the ultimate question as we head into the weekend. Are these signals just some low-volume holiday noise, something easily forgotten, or are we actually witnessing the early signs of a much more significant regime shift? I guess Monday's open will give us the answer.